Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode. Okay, good morning, guys. I'm back after probably a couple of weeks break, tanning myself inside a hotel room with two very young children.
Well done.
Not feeling too refreshed, but back nevertheless and ready to go again. How are you guys? How was last week's episode?
Last week's episode was pretty good, I think. We talked about space, construction of space versus construction on the planet Earth. We had Gabe with us, so that was pretty good.
Martin, I feel like we're supposed to say, oh, and it's not the same without you.
Oh, that's the...
Thank you, Patrick.
This small talk thing.
Should we cut Martin's bit out? Hey, Patrick, I'm curious, how's the newfound fame following the release of the Super Series?
I don't know about fame. I don't know about newfound. I don't know about fame. But our team is enjoying it quite a bit, and I thought it turned out fantastic. Thanks to you guys for making such an effort. I think the whole recording experience was great. The post-production you guys did fantastic, and then obviously the distribution. Couldn't be happier. It's been, and look, I really think. What I wrote online, right? This is, in my opinion, a first of a kind. I can't remember any VC firm ever in history actually doing an 8-part documentary series, pulling back the curtain. So, that in itself is quite thrilling to us.
Yeah, very revealing. And it was actually very good. I feel like with the VC industry, it's a lot of smoke and mirrors. And as an outsider that we are, it's really actually quite hard to understand what goes on inside a firm and what they do. And I'm sure there's a lot of narrative building of versus like on the outside versus what goes on the inside. So it's very nice to get that inside look of what goes on with you guys.
I appreciate that at least you give us the metaphor of the smokes and mirrors and not the lipstick and animals and stuff.
What I particularly enjoyed, we covered it from various different angles, from like your beginnings, your thesis, like how you see verticals, how you see the future, etc. So it's a documentary, really.
Really is. No, it was fantastic.
Very good. Okay, so guys, let's dive in. Today we're going to speak about a little bit about nuclear power. So there's a company which I am sharing my screen showing called Last Energy, who have just raised a 40 million in Series B funding, and then we will move straight on to some investors' takes. So let's go through this first article. So Last Energy raises 40 million in Series B funding. They're based in Washington, D.C., and they're a full-service developer of, I'm going to pretend like I know what I'm talking about, 20 MWE micro-modular nuclear power plants.
So MWE is megawatt electric. So that's the output of their plants.
Perfect. So total capital raised by the company is 64 million since the company was founded in 2019. And the Series B will enable the company to continue to expand this team, invest in project development as it works to deploy its first plant, targeting 2026 to come online. Investors for the fund round include GigaFund. Is GigaFund the Autodesk Foundation? That's two separate investors, right?
Yeah. I think so. Yeah.
Yeah, and a series of family offices. So, what do you guys know much about Last Energy?
Well, I don't know much about Last Energy, but I think it's something very important to work on. As the only thing similar it was completely different. We discussed Fern a few months ago, but that was kind of modular. It wasn't power plant at all, but that was kilns for modular kilns for cement production. But it is a little bit with associated with energy. But in this case, I think it's super important. It can be a very big breakthrough if we can really scale them and install them in various places on Earth, so that we can have, I guess, clean energy and very cheap energy.
Yeah. Patrick? Do you know like a very simple layman's explanation of what they do?
Yeah. So I don't know about layman, but essentially what they are doing is they are bringing the technology to construct nuclear reactors that serve as power plants to deliver electrical energy into the 2020s at a more serialized and standardized fashion. So whichever country wants to wean itself off of fossil fuels, not be dependent on other countries' gas, for example, and also recognizes the problems that comes with too high a share of intermittent power generation, renewables, specifically solar and wind, is potentially a great customer going forward for something like this. And so that's what they are doing. They're offering a full stack solution from the whole design, development, all the way to the construction and commissioning of small nuclear reactors in a modular and standardized design way. We can unpack a lot here. As you guys know, I have a background in energy, so happy to dive deep on any of these topics. That's what these guys are doing.
So 20 megawatt is quite a bit, right? Like when I see a solar energy plants, if I can call them like that. At least in Poland, I used to saw like 1 or 2 megawatts usually. So that sounds like 10, 20 times more than that. What can you, like how much power in reality it is? Like, can you like cover small village or small town with 20 megawatt or?
So 20 megawatt is not a lot in the scale of nuclear power plants or even like grid scale power plants. So most power plants that run on a nuclear reactor would be up to 1 gigawatt, so 1,000 megawatt actually. Oftentimes you would be in the range 500 to 1,000. The modern ones in China typically have 1,000 megawatt, right? So just in the scale of things, 20 megawatt is not a lot compared to other nuclear plants, even compared to gas turbine power plants, coal power plants. That wouldn't be a lot compared to large renewable power plants, solar. It would be, the largest ones would be, or the larger ones, I should say, would be in and around that range. So that's where it compares favorably. But that's actually not the promise here, right? So in order to get a 1 gigawatt nuclear power plant up and running, let's take the Chinese pipeline. The Chinese have spent decades on standardizing and modularizing power plant design, construction, and commissioning, both on the coal side as well as on the nuclear side. And
such as small ones or larger ones?
No, the gigawatt size, okay. Right? And so that's because the country, obviously, through the decades, has needed to provide a lot of energy for its growing economy, for its rising middle class, etc. But in the West, and the point is because they had such a pipeline of massive demand in a relatively short amount of time, speaking decades here, 2-3 decades, they had enough incentive in order to standardize and modularize their plant designs, development, construction, commissioning. Now, the West hasn't really had that over the last 5 to 6 decades, right? So right after World War II, there were 1 or 2 decades where a lot of power plants on the nuclear side, as well as on the more conventional side, were commissioned. And that was the phase when we could have standardized and modularized, but we didn't in the West. And so after that, the new commissioning of nuclear power plants as well as traditional conventional power plants in the West was more sporadic, right? So that there was always something going on, but it wasn't at the magnitude of, hey, this now warrants us standardizing and modularizing. And so that's unfortunately the state in the West when you look at nuclear power plants. So that means, to give you an example, I think the most modern French nuclear reactor that is about to come online is already 17 years into construction. That's how long it takes, right? And that's a result of not standardizing and not or partially not standardizing and not modularizing. And so that's where Last Energy's promise sits, is, hey, we're actually going to bring all the economies that haven't had a similar approach.
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
Like the ones that standardize and modularize their nuclear power plants into that same age, but we need to do it on a smaller scale in order to bring them up on and online much, much quicker. So not in 17 years, but hopefully in a matter of much less.
Yeah, that's super interesting.
On the note on you mentioned China there, I found this little some interesting facts about China's nuclear reactor push. Shout out to Bragan because it's on his Last Week in Contact newsletter. So apparently, more recently, 11 nuclear reactors were approved across 5 sites. Apparently, in the last couple of years, there's an additional 10 units. In each of the last 2 years, an additional 10 units were approved. So the total investment for 11 units would be at least $31 billion, and construction taking approximately 5 years. And the country has 56 reactors currently in operation.
Sorry, which country?
China.
Yeah.
With a combined capacity that equates to around 5% of total electricity demand. And to add to that, China has more nuclear reactors under construction than any other nation in the world.
Yep.
It's expected to surpass France and the US and becoming the world's leading atomic power generator by 2030. So for context, I guess they're building 11 reactors for $31 billion. The US has recently built 2, which cost $14 billion. So it looks to me like there's also a drive here to completely push and cut the cost of producing these reactors down.
I mean, that's the benefit you get from standardization and modularization due to a very consistent and guaranteed pipeline of demand.
So would you say maybe that Last Energy is US's answer to China's rapid rise of nuclear construction?
It's not the US only. So it's a US-based company, but actually, without talking about, so, we've spoken to the company for this round. We've been super impressed. Ultimately, we had to hold off just because the deal economics for a fund our size didn't make sense. But if it had been a round or 2 earlier, we would have been all over this one. It's a fantastic company, fantastic thesis, timing, why now, leadership. Honestly, it's a terrific company. So I won't spill the beans. I will speak from the market side. So if you look at companies like Poland, countries like Poland, if you look at countries like Romania, these are the countries in the West that will actually have a very strong incentive to make sure that they are independent of gas. Let's call it apolitical gas. No specific region the gas might come from. Just, we don't want to be dependent on gas in these countries. And that means that they need very quickly to shift their power generation on the grid scale away from that, and to wean themselves off also generally from energy imports. So that's where nuclear energy can provide a real solution, but you need it in 5 years. You need it in 3 years. You don't need it in 17 or 20. And that's exactly, these kinds of countries and economies in the West, not just the US, actually outside of the US, I expect to be the biggest demand for something like Last Energy.
Yeah, and also probably African continent is, I guess everything depends. Well, not everything, but lots of things depend on the how the world will be pushing the green agenda. Really. Maybe the question is also: are these nuclear power plants considered green energy or not?
Now you can have you can have a rational debate about this, and you can have a political debate about this.
Rational.
Okay, the rational. I would say yes. It's
so it
in
is.
In terms of the emissions, it's the cleanest form of energy, the same way that you would have for hydropower, for example, right? Now, if you disregard the decommissioning issue and the storage issue of the spent fuel rods, right? So if you disregard that is itself another issue. It's not in the form of emissions. It's in the form of, shelf life of spent nuclear material. So if you disregard that, yes, it's the cleanest form of energy that you can have currently.
Do you know what's the economics of this plant, or maybe how much does it take, or what's
that would be spilling the beans? So let me not do that.
Okay.
Patrick, how about the founding team? Because it's quite a you would have to. It sounds to me like you would have to have been in this field for some time to understand what goes into constructing one nuclear plant and two, then making it modular.
As a founder, potential. I mean, it never hurts. And however, I don't think you have to. After we researched nuclear energy for 100 years plus. And we built the first grid-scale nuclear reactors in the, I want to say, 1950s, which were, potentially about the same scale as this one, right? I think the UK's first reactors were about the same scale as this one. So the whole industry and the concept of how to safely, and then efficiently and economically generate electricity out of a nuclear reactor, that is pretty much an understood problem. How to standardize and modularize that, the Chinese approach has also proven that it can work, has been more of an effort of the last 20 to 30 years. So as it relates to the founder team, I do not think this is such a nascent technology. That's my point, right? It's not such a nascent technology that you say, oh, I need someone that, worked 10 years on self-landing rockets in order to build a new company that does self-landing rockets. No, this is a skill that is widely available in the market that you can hire for. And so that's exactly how the Last Energy team looks to me, actually, is the founder is someone that initially had a company in robotics and specifically drones, if I recall, sold that company and then spent a lot of time researching the nuclear opportunity. So it's not like he jumped into this, at least that was my impression, head first and I have this whim now and I jump onto it. No. He spent a lot of time researching, if I understood that correctly, and developed his own thesis and then built a team around that actually has the required competencies.
So so you say that this is not inventing new technology, really, right? Creating modular nuclear power plants, or can it be called a new technology?
I mean, not on the nuclear reactor side, no.
Okay.
I mean that is proven.
And I'm very curious. Obviously, it depends how much can you say about this, but I'm very curious when you were speaking with the founding team, what is their vibe regarding the regulation? And obviously, having installed modular small power plants in various locations in a country, someone can say that this might pose some risk or some threat, localized risk or threat because of this nuclear material in there. So how does this industry sees this to overcome this problem potentially from the regulation point of view? Do you have any thoughts on this?
It's one of these risks that you hate as a VC. If you guys recall the hidden in spite of obvious framework that we discussed during the documentary, the Super series. So this one sits a little bit top left in that you're taking some crazy market assumptions that you hope will materialize in the form of regulation. But it's obvious to the demand side that this is needed. Now, that is a spot where as a founder, but even more so as an investor, you would like not to sit. However, in this specific case, I think it's a very, very reasonable and probable assumption that you will find 50 plus economies around the world that are going to not just loosen regulation, but actually provide favorable regulation to scaling up their nuclear power generation portfolio in the country. Poland is one, Romania is one that I've just mentioned. Africa, you mentioned, could be the same, although you have to always consider that let's call it economic bonds between some parts of Africa and China are already very, very strong on the infrastructure side. So the opportunity for someone like Last Energy in Africa might be a little bit different. But generally, I would see this one in many European countries, especially Central and Eastern Europe, UK as well. Very favorable. There's a bit of regulation that is going to be required, but I think that's a very reasonable assumption that that is going to happen.
There's a timing issue also potentially as well, because all these arguments could be also told, let's say, 10 years ago, 15 years ago, right? And they wouldn't materialize. The idea wouldn't materialize because it hasn't actually. So that's interesting.
Yeah, but now the world realized that it's not so good to be dependent on other people's gas.
Sounds very human.
Maybe let me add one more perspective why actually nuclear energy makes so much sense for another reason, right? So in energy, one of the concepts that as an let's say energy economist like myself, an energy manager, is the merit order. So what is the merit order? The merit order is what from the power production curve you're mapping out. So think of basically the amount of electricity that you can generate from different types of energy in your energy mix. And at the bottom of the merit order, you have the so-called baseload energy. So baseload energy is the one that, is exceptionally cheap on, and that's the vertical axis, a incremental marginal cost of what does the next kilowatt hour of power generated cost me. And the baseload energy at the bottom of that merit order is the one which has almost zero, not exactly zero, but almost zero incremental marginal cost of the next kilowatt hour produced. At the bottom of that sits typically hydropower. So hydropower is basically, I have somewhere, let's call it a huge waterfall, typically at the top of a basin that I artificially created. I have certain hydro turbines that sit in the dam. The water falls through, the hydro turbines go. Except for the maintenance of the turbines, it's free energy that I generate.
But you need to build it first, right? As well.
Of course, but I'm speaking of the variable cost of operating it, right? So the capex sits outside of the merit order. The merit order only looks at the variable cost of generating the next kilowatt hour. So that's where the hydropower sits. It also sits, and that's a correlation, at the bottom of the merit order. The power that you have there typically doesn't ramp very well. So it's not like I can switch it on and off very flexibly, right? So it tends to be relatively costly to sit there. So for example, to switch off the hydropower plant, I need to shut certain gates, etc. It can be done, but it's not particularly quick, right? What also sits at the bottom of the merit order is nuclear energy. Nuclear energy is not very good at ramping. You would never use it in order to, for example, balance the grid on a minute scale or 15-minute scale, just because the reactors, they need time to heat up, warm up, power up, power down, etc. It would probably cost you a lot in maintenance if you were to do this, but it's very, very cheap energy to produce. Not exactly like hydropower, but very cheap. Now, at the top of the merit order of producing energy sits something like gas turbines. Gas turbines is relatively expensive energy, but you still want to have it in your energy mix oftentimes because it's super flexible. You can basically switch it on and off to balance the grid, right? And so in between, you have lignite, you have coal, you have biomass plants, etc., right? And so that's how your merit order stacks up. And the more energy you need at any given minute, the next plant you might switch on, which sits higher in the merit order, so that the next kilowatt hour that you produce typically is more flexible, but also more expensive. So that in itself is a concept that energy managers use a lot. Now, if you put the merit order of demand next to it, that's when it becomes very 2024. So typically, a lot of the demand that we would have is not necessarily baseload. So baseload demand can be something like let's say an electric furnace in a steel plant, which typically, if it's at high utilization, you would expect that to run through all the time. And you can ramp it, you can somewhat ramp it. For example, if the grid operator gives a signal to the steel plant, hey, right now I need to balance the grid. You guys participate in the balancing market. So here's the signal. Can you please switch off the furnace for in 4 hours for an hour in order to balance the grid. And so if the electrical steel plant were to participate in that, this type of baseload energy would go away and you could balance the grid, right? But in all, you don't have a lot of baseload energy on the demand side of the grid. It's a lot of fragmented power that can come on any point in time, and that's why you need grid balancing. Now comes data centers. So
Yes.
Data centers is a form of baseload demand that we have on the demand side, and we're going to build so many of them that you will actually see in the merit order on the demand side of energy, more and more baseload energy that comes from data centers. And that's where something like Last Energy makes a ton of sense, because you can put it next to data centers. And if you're building it the right way, I'm positing that, and I'm pretty sure it works, you can actually even avoid feeding it into the grid. You're basically building a microgrid just for the data center.
Very good.
So baseload energy is basically like energy that will be required constantly all the time through the like predictable amount of time. Period of time.
That's a fair definition, yeah.
Yeah. That makes sense if you've got devices or facilities demanding this energy, which you can very nicely calculate the demand for it. You can place the factory next to it, and definitely makes sense.
Yeah.
And all of that is important because if you're not a physicist, maybe you haven't spent time in the energy field. That's important because the grid does not store energy. You have to understand that the grid always needs to be balanced. I should have said that.
Patrick, very open question, but purposely so. When, as an investor looking at companies that are tackling things similar to this, i.e. Energy generation within the globe, is there a thesis or a certain few things you're looking for? Apart from maybe the obvious stuff like good founding, team, large market, blah, blah, blah.
And your question is specifically to energy-related things?
Yep.
I mean, look, for us, it always has to have a connectivity to construction, renovation, infrastructure. If that's not a given, then we're not the ideal fit. So any kind of energy type of startup that doesn't have any of those three, I'll be more happy to introduce them to my friends that focus on energy with their funds. And that makes more sense. But there's a very strong intersection in that Venn diagram between construction/infrastructure and energy. And that's the intersection where we like to play. Last Energy would be one of them. I just recently actually led us a pre-seed round in the Western markets for a company that is in the grid reconstruction space and that is helping utilities and grid operators much faster renew their grids. And so that is something that sits exactly in that part of the Venn diagram, and I like that a lot. And the thesis for that is there are multiple ones. One of the ones that I'm most interested in is actually that with the whole electrification of everything that we're doing in the West, which I'm moderately critical of, but it is happening. There's enough political will, and so be it. The amount of grid renewal that we have to do over the next decade, then 2 decades, then 3 decades is absolutely insane, and we don't have the supply to do that. So my thesis is I'm liking every kind of company that fixes supply for grid infrastructure and grid renewal.
Is there a lot of startups doing it? Because this is the same thing I hear from my friends in Poland who are in this industry, that the demand is gigantic, but there is no planning permissions for these solar power plants or wind turbines. Just because they limit the supply because of the grid issues. And this doesn't seem to be coming any better. They're waiting for the funds from the EU to start doing something. So what type of, I'm curious actually, what type of technology are you looking for to streamline this? Because that's very capital intensive activity to build a grid, I guess, right? You need to do excavations, and put cables or the transistors or whatever that is.
And don't forget, you've got to plug it in as well.
So the if you think of the transition lines, so the cables, that is something that obviously just visually everybody has in mind, but that is perhaps even the least of our issues, and even that is a big issue. But think of, for example, the transformers inside the substations that you actually need. So the power grid is organized typically if you dumb it down 3 layers, so you have high voltage, mid voltage, and then low voltage, which is the local distribution grid, and you need to transform the power, through the grid levels at different junctures, and that's the substations. And so, and again, this is dumbed down. There's even further nuance to that, etc. And so, just the amount of materials, the assembly, the construction of the transformers in this and the whole substations is an unfixed problem. We actually have a material issue there on top of a labor issue. Now, for the cables, that is the exact same thing, what you are describing. Inverters for your solar power plants, decentral as well as grid scale, same problem. So on every level, we're having material and labor issues on top of permitting, financing, workflow, supply chain issues. So it's a real cloud manufacturing opportunity, and it starts with material and labor.
Good, just industry to be in, I think.
Yeah, very, like you mentioned, Martin, earlier, timing. Good time to be involved. Okay, guys, should we move on to Jeff Lewis? Jeff Lewis, who says, a generation of venture capitalists will soon learn that carry dollars, in air quotes, are worth zero when a fund does not reach carry. Is this sarcastic or what?
It feels so. I can also tell you more about Jeff. It feels like a mix of sarcasm, Schadenfreude, and almost sadness for the state of the industry. That's how I'm reading it.
So maybe let's unpack it. What are carry dollars?
Yeah.
So in private equity, of which venture capital is its own subset of an asset class, the partners that raise funds and manage funds on behalf of their investors typically have an agreement with them that they invest their own money alongside the investors, right? That's important. But on top, for a certain, let's say there is a profit in the fund in terms of cash, not in terms of book value. They receive a profit share of that profit, and that's called the carried interest or short carry. Now, there's a lot of things that go into carry and a lot of terminology and further agreements of when you are actually in the profit or not. But essentially, that's what he's talking about here.
And that's this agreement is usually 60-40, 80-20, or some other percentage?
Typically, but it is a range, and you will see different ones. For a classic venture capital fund, in most of the markets, the carried interest would be 20% of the profit. So not 20% of the fund, 20% of the profit. After, and that's now one nuance, certain preferred return has been guaranteed. That's the called hurdle rate. There is a waterfall. We'll all go too far, but there are certain other conditions that have to be met on top of that in order for you as a general partner team to access the 20% profit share that you typically in most VC funds see.
So let me try to interpret what he just said. He said that VCs will not get their own 20% because there will be not enough returns to cover even 20%. Well,
they will not be.
There will be no profit. There will not be profit. There won't be profits.
Correct. That's what he's alluding to.
Interesting. Yes. So how long are VC funds usually because that's relevant?
Most of them would have 10 years classically, and then typically in a VC fund you have something called extension options. So oftentimes the managers of the fund, the general partners, would have 2 1-yearly options in order to extend the fund to 11 years and then potentially to 12 years. There are exceptions in the VC asset class to this. For example, if you're a growth fund, you might have a shorter lifetime for your fund. If you're a fund with a very, very, very strong climate remit, some of them have longer fund lifetimes.
Evergreen,
yeah.
And Evergreen doesn't have a fund lifetime at all, yeah.
Mm-hmm. Yeah. So there's always here as well, timing kind of problem, because what is he talking about? Is he talking about will soon learn? What does it mean that the investments that have been made in, let's say, 2019, which should mature 2029, for example, or funds, sorry, not the investment, but the funds should mature in around 2029, for example, will not carry these returns? Or how do you think about timing here?
Yeah, you nailed it. So he's basically again, there's a bit that you have to interpret here for Jeff, but I feel relatively certain of what he's alluding to. So he's alluding to the fund vintages of 2018, 2019, more so probably 2020 and absolutely 2021. And by the way, it's going all over again in 2024 with people investing in AI like nothing happened, where these funds have been spending money like drunken sailors. And then they realize 5 years. So a quick sidestep. So there is a conventional rule of thumb or wisdom that you know what you have in your VC fund only after at least 5 years. So in the first 5 years, your books can look fantastic, but there's a lot that can still happen to all of your companies. And this wisdom, I can absolutely confirm it, is also meaning that sometimes in year 6 or 7 of your fund, you have a company in your portfolio that you almost had mentally written off and that comes back and is a huge hit. And it can also happen in year 6 and 7 that a company that you constantly carried very high on your books because they raised a lot of money, there was external funding, the share price got increased, and you were like, looks totally like a winner, and then it loses out against competition, or the regulation doesn't break your way, etc. So all of these kinds of it has also happened that there were tragedies in the founder team, right? And so all of these things can happen along a journey of 10 years. And so back now on track. So with this 5-year rule, if you look at the 19, 20, 21 vintage, they are now nearing the realization of what are the stars and the dogs in their portfolio. And he's saying, in these vintages, a lot of funds invested in a lot of dogs at a lot of shit prices.
And that's general funds or more specific or industry agnostic funds, or?
I think you cannot truly differentiate here. I think the bigger differentiation is whether you're an early stage fund or a growth stage fund. So the growth stage funds that invested, for example, there have been entire fund generations. Let's say a 2021 vintage fund. Get this, guys. I mean, it's very, very hard to believe, but it actually happened a lot. An entire fund generation that was raised in 2021 that was then spent 100% of the capital in 2021. So that is a lack of what we call in venture land time or temporal diversification. So it's not diversifying you actually accessing different types of different years and different times of the market.
Gigantic FOMO wave.
I mean, yeah, whatever it was, right? I mean, that certainly played, into some of these decisions. So if you're now a growth stage fund that did that, unless you had 1 or 2 companies in there that you bought exceptionally well and at that 20 or 30x from there, most likely you're going to get caught in a very, very bad vintage year. For the early stage funds, you can still, so for example, our 2019 fund would not fit what he's describing here, right? I don't want to go into details, but our 2019 fund is very, very good and is beating the trend. But that's because we're like top X%, single digit. Now, the other 95% of that vintage year probably fit what he's describing here from an early stage perspective. But you have like 10% of the 2019 vintage that actually have fared better in the early stage world because, they had a few winners in their portfolio, bought at great prices, and then, these still get continued and carried over into later years. But on the growth stage, that is hard because you're already overbought at very high prices and your fund lifetime is oftentimes shorter because the companies are already so mature.
Interesting thing also, you said that if these funds deploy the whole capital in 1 year, then they don't have money to follow up, right, for the next round, for example, as well.
Yeah, because the idea always was that, hey, I'll just raise a new fund in 2022. The hypothesis was always, hey, I'll just keep the faucet open.
From like a business perspective, how do VC handle the fact that you might not realize your profit out of what you're doing for like 5 years after perhaps the capital was invested? And then 2, it's also not guaranteed, right? So like what he's saying is if you're a VC and you get paid your management fee to manage the fund, but then also your carried interest is the profit. So How do you maybe forecast, and then perhaps what happens when your vintage doesn't result in profit? How do people deal with that?
They change the career.
I wish. I wish that would happen. Oh man, this is such a loaded question that has in and of itself like 3 hours of an all-in podcast type of a.
I've got time. Let's go.
No, but look, there's not one or two answers that would capture all of the possible scenarios of your question. Let me give you one or two, and they are nowhere near covering the whole breadth of what could happen in the market. So there's funds that have billions of dollars of assets under management. And that means that the general partners, the extended team, can afford very healthy salaries to live off of. I'll leave it to your imagination what healthy is. And they can sustain, let's say, one or two fund vintages, not accessing very strong carry. They can sustain their lifestyle, but also perhaps oftentimes, if you're in the $1 billion range of a fund, it should come off of, hey, I have 4 fund generations, 5 or more before that actually performed very well. So a fund manager can survive with such a track record, one bad vintage. But a lot goes into whether that is actually happening. So that's one example, right? Now, if you're more of an emerging manager, imagine you raised a random number, $350 million first fund right out of the gates in 2020, and you spent a lot of that in 2020, 2021. You might have a very, very poor vintage as your first vintage, and then and then convincing LPs to actually give you money for a second fund or to just scrap it and start over with a completely new fund. I imagine that is not going to be particularly easy. But on the other hand, stranger things have happened.
Maybe there's another FOMO or another kind of.
I think it has to do with LP sophistication. So limited partner sophistication. The capital that sits upstream of the VC managers, the limited partners, especially the institutional ones, like to think of themselves as highly sophisticated, and they are. But I also perceive a portion or a subset of them as telling themselves they are highly sophisticated, but actually they are just lazy. And they are looking for ways to spend 30 million checks, which in their books is very little, in a relatively simple social signal type way. And what does that remind me of? Exactly of some of the VC managers that they are backing. So, which means that if you can tell a story, if you have great academic logos, if you have a lot of friends that you can, appeal to and say, hey, but I know these guys, someone like that will always find some kind of capital.
That's so disappointing. The people not look for the substance and the foundation, but for the marketing and glitter. Yeah?
Litter.
Question, I think, and we've been talking quite a lot about this, so that's not our usual play here, but you mentioned LP sophistication, and is that so? For example, let's bring it down to back to construction tech. So there've been a growth of capital deployed in construction technology in the last few years, right? I think we can all agree. And I'll go back to the rates because I think they are underpinning quite important dynamics in general. That having the interest rates going down, would you agree that limited partners will have more capital to deploy into venture funds? And would that be the case?
Long term, yes. Short term, I think it is highly unpredictable. What happens if you want to go down rabbit holes with me, which perhaps would explode this episode? Just look up what happens typically when the Fed lowers 75 basis points, the federal funds rate. Half of the time, 60%, that actually leads to a recession. So short term, the amount of capital available to VCs, if a recession has already been triggered and is going to play out over the next 18 months, would perhaps not be the case. That is, entirely up to you and speculate as you will. I'm just pointing out the historical correlations.
Not a financial advice. That's what you're saying.
Yeah, and also I don't know. I mean, I'm not claiming, oh, I know, but I'm not telling you. No, that's not what it is, right? So, but long term, of course. Like, I mean, if the money supply in circulation increases, then that also trickles down into VC and venture.
Okay.
And the cycle will continue.
It's, eternal cycles. Another fun read, by the way, for the listeners, look up the 18 years real estate cycle. It's a very fascinating read.
Okay. Who's done that? Is it like a article or?
I think it's multiple people who contributed.
Okay.
If you Google it, you can find it.
Okay, thanks.
Okay, guys, shall we move on? Perhaps how you should think about your fund size. This is very dense. This statement. Anyone else want to give it a go?
I knew you would try to outsource this. I knew that.
Outsource.
I knew you would try to outsource it. I think you read very well, Owen. Let's start with the first.
Okay, I will read it, but I'm not
Yeah.
going to pretend like my brain can comprehend the level
Just
of
focus on
mathematics.
the middle part.
Okay.
If you take the middle paragraph, you'll be good.
Okay, cool. So, blah, 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 middle paragraph. A $500 million fund means it needs $15 billion of exit value. Okay. 10% ownership at exit is $1.5 billion, which is the 3x gross multiple. Shall I stop there?
Go.
I mean, 15 billions of exit value in one fund means 15 unicorns, or a decacorn and 5 unicorns. So
that's a good hit, I guess.
Okay. From a 500 million fund?
yeah,
It was a good hit, yeah? Okay.
No, that thing means that it's nearly impossible to get that done on such a big fund.
that is an implication. Yeah.
Fine. $15 billion of exit in... Okay, yeah, here it is. So $15 billion of exit value in one fund means 15 Okay, you just said this. 15 unicorn exits or a decacorn exit and 5 unicorn exits. Patrick, it's like you already read this. Assuming a portfolio of 35 companies, that's quite a hit rate.
Yeah.
That is quite a hit rate. So what Michael is pointing out here is, so he's pointing out the economics of how fund size in relation to the return expectation can completely distort what you need to hit in what's called a power law industry, where there's only so few great generational opportunities to become truly, not even talking Coinbase or Airbnb outcome size. Let's say just 10 billion outcome size is incredibly rare, and that's what he's pointing out. And that also, he's making now the making it visible for everyone, just what it means in terms of like, let's say every day is that you need to generate 15 billion of enterprise exit value. And that is 5 unicorns, 1 decacorn, right? And so that is just, when you put it like that, a $500 million fund is very, very hard to earn a 3x return on.
Is it not the case that these famous venture capital companies like Sequoia, like A16Z, something like that, and I don't know about many actually, but they are
Global.
gigantic. Oh, I think this is the largest, right? They have gigantic funds of billions, probably even. So how do they do? Like, do they deliver this, or do they don't, or they just again marketing thing?
So when you talk to, no, I shouldn't say you. Let's talk about myself. When I talk to institutional LPs and very sophisticated family offices, I tend to get the exact same answer with regard to this question. There's some nuance left and right, some personal return preferences left and right that differ, but in its core, it's the same answer. And the answer is, okay, I have 2 types of venture fund assets that I want to be invested in. I want to be invested in with a portion of my venture fund allocation in funds that can give me a highly certain but not super attractive return. I'll come back to this. And then the other portion of my venture fund allocation, I want to be in funds that can give me a perhaps not so certain but much higher upside. And in between, I don't want to be invested in, if I can. Now, the first portion is exactly what you're talking about. That would be, funds that have a very, very long and revered history, that have a brand in the market that founders gravitate towards, that other investors, social signals, gravitate towards, that for that reason see at a Series A or Series B stage, CDE, every kind of deal, and typically 5 out of 10 times could access the deal if they wanted to. And this provides them a certain stability of being in the best companies after they have become obvious. That is important, right? And however, these funds have billion-dollar sizes. And so that's why in this portion of the venture fund allocation of such of such LPs, they are not expecting 3x returns. That's the unspoken truth. They are expecting 2x if it's good. In reality, they are getting 1.8x gross. Do your research, that's what you're going to find. 1.8x. Over 10 years, that's relatively poor.
That's very poor.
It's not good. Yeah. It's not good. But it is, in the eyes of such LPs, it's near to guaranteed. Yeah? I would dispute whether that is the case because you will have shit years, and then it's actually not near guaranteed.
Yeah.
Right? Now, the other part of the other portion of their venture fund allocation, hyper sophisticated LPs, and there are not many of them, would look for 5 to 10x venture funds, right? And so oftentimes, there's some wisdom, hey, that can only be done by emerging managers, which I think is a simplification. We're emerging managers, so I like to hear that, but I think that's a simplification. I think that is not correct. I think it has more to do with your ability to stick to a strategy and a routine and a repetition that works. And at some point, the incentives of you growing larger and larger funds, that has nothing to do with being non-emerging anymore, but it comes from a different place, makes you change your strategy, and that makes you change your return profile. So what you need to spot for if you want to look for these kinds of funds is strategy plus differentiation plus execution. And so, in my opinion, a lot of the future funds and a lot of the historical funds that fall into that bucket are specialists. They are vertical specialists or they are topical or thematic specialists. Like, for example, someone that specializes in open source, right? Or someone that specializes in, let's say, nuclear technology, right? So these are the funds that are going to have access to companies before they are obvious. And if they have a very good strategy and a very good differentiation, a disciplined execution of that, you are able to access 5 to 10x and in excess of 10x even types of funds. And so that's what LPs that are sophisticated, how they are thinking about the allocation. And in the middle, they are not seeing much. And that's the example that Michael is giving here. So a 500 million fund that wants to fish in this pond, it's very hard to access 3x.
Interesting. So you'd be either very big or small.
That is my personal thesis. I think my partners share it as well, is that I personally think the future of venture 10 years from now will exist of very large fundraising venture fundraising platforms and very good early stage deployment platforms, which are oftentimes vertically specialized. Mm-hmm. And I think the whole mid-market, not that it will vanish, for that there's too much capital around, but we'll get into a real return squeeze.
Mm-hmm.
Good. I think that's a nice way to end the episode. What do you think, guys?
Hey, Owen, can I give one additional example? Just so that math that Michael is giving, I sat down when I was in Paris earlier this year with a good friend of mine, GP of a large European fund. And over lunch, he told me the exact same math that he's doing. He said, hey, look, in total, we're currently managing 1 billion in assets under management. He said, on average, we own 10% at the exit, right? So he said, hey, I own 1 billion. I need to return 3 billion. And because I own 10%, that means 30 billion of enterprise. And because I'm 1/10, that means Europe needs to produce 300 billion. Sorry, I just skipped one decimal there, right? So it's absolutely crazy. So his portfolio needs to see 30 billion of enterprise exit value, and Europe needs to see 300 because he's a tenth of that.
Wow. That's a lot.
That's a lot.
Okay, guys. Quite heavy on the VC stuff today.
Yes. That was interesting, actually.
Good to
Very
hear.
interesting.
I would say that if people want to maybe get like a little bit of a lighter touch on introduction to the world of VC, probably check out one of the first episodes we've done with you, Patrick, back in, that was actually released January this year, believe it or not. Maybe even later. But it's quite funny because I think probably definitely at least a year ago from now, I had no idea perhaps what the series fundraise
Carry is.
what carry was, what the typical rounds are, what an LP was. So if you do start focusing, I'm nowhere near the knowledge obviously of a professional like Patrick, but you do start to get there. Okay, guys, thank you so much, and we'll see you next week here.
Thank you, guys.
Thank you. See you.
Cheers.